Good afternoon, everyone. My name is Brian Overby. I am the Senior Option Strategist with Options Play, and welcome to Generating Weekly Income with Covered Calls. This is one of my favorite presentations to do, and mainly because I think this is one of the most popular strategies that a lot of option traders like to employ. And the main reason why is it's really an enhancement to owning a stock portfolio, how to generate some income above and beyond any dividends that the underlying stock might pay, and doing that using option contracts and specifically using the covered call strategy. So before we get too far along, I want to do a little bit of house cleaning items here. Options Play is empowering you to do some education. We're going to actually go through how to use the Options Play platform to try to come up with a covered call strategy that you might like. And then we have a disclaimer, right? Everything that we show you on the slides today is not meant to be a recommendation. We're going to be showing some real-time quotes. That's not meant to be a recommendation either. And if you're trading options, you should always check out the characteristics and risks of standardized options. You can get that by clicking on the link here, or you can ask your broker for it, or go to the Options Clearing Corporation to get access to that. All right. So my goal here is a simple strategy to generate weekly or monthly income using options. Now, our simple rules that we have is how to generate a consistent income stream with clear rules as to when we want to sell and when we want to be in that position. Now, passive management is what we're looking to do here with our covered call position. It requires management once a week, and you always hold option positions to the expiration date. So if we're approaching this as a income strategy, we're going to continually do a covered call on whatever underlying stock that we decide we want to do the call on. And I mentioned here that I think it's the most popular option strategy, and that might surprise some people, but a lot of people think that if I'm coming to the options marketplace, I'm going to get rich using the leverage and buying call options on bullish stocks and buying put options on bearish stocks, on stocks that I'm bearish on. And that's not necessarily the case. There's a lot of people that use options to enhance a stock portfolio. And I almost think that that should be the title of this slide. Options to enhance your stock portfolio, because you need to own the stock in order to do this strategy. And some people just use options as a way to sell the stock if the stock goes higher, or actually buy the stock if the stock goes lower, which we're going to talk about that strategy shortly too, when we start going to the next leg of something that we call the wheel strategy, where you sell a put to actually buy the stock at a lower price, and then sell a call once you buy it to try to sell the stock at a higher price. So very straightforward. And who's this webinar for? It's not for the people that are speculating on option trading. It's actually people that have a portfolio of stocks and want to generate income above and beyond. Now, with most individuals, this strategy is exciting for even people who have IRA accounts. If you own a stock in an IRA account, you can usually get approved for covered call selling. Now, you do got to get the approval to be able to do that, or any type of retirement account. And it's a way to generate some income inside that retirement account, above and beyond dividends, once again. So most investors that keep the majority of their wealth in long-term equity investments. In other words, I'm buying a stock and I'm planning on holding it. Securities for your portfolio can generate consistent yield every month. You can either get the yield through dividends, or you can try to generate income above and beyond that. And it requires a few simple rules to achieve a consistent income stream. And we're going to go through those rules today. All right, so what is a covered call? First of all, usually if you're looking to do a covered call trade, you own 100 shares already. Now, you can enter a trade where you don't own the 100 shares and you actually buy the stock and sell the call at the same time. That is actually called a buy right. That would be the vernacular that is used inside the industry jargon, if you will. But in this instance, we're talking about owning 100 shares of stock, or it could be an ETF, an exchange traded fund. For example, the SPY is an exchange traded fund. And you sell a call against it saying that if the underlying stock gets to my strike, you can call the stock away from me. And this is another little surprise for beginning option traders. That's where the term call comes from. It comes from the sell side of the position. If I sell it, it allows you to call stock away from me. So if I sell that call, that's what I have an obligation to give up my stock at that strike price. So I own 100 shares of an optionable stock. I'm going to sell a call using the stock and ETF as collateral, and I'm going to receive premium for taking on that obligation to say that I will sell the stock at a higher price at a later date. And it creates that obligation. So in this instance, if I bought the stock, and this is just a very generic profit and loss graph here, if I bought the stock, my cost basis would be what I paid for it. And then I would have unlimited upside, right? Because I own the stock. But I'd also have substantial downside. By doing the covered call, I'm saying, well, if it gets up to this level, if it gets up to right here to the strike price, well, you can call the stock away from me and I'll give up any other gains from here on up. But I get paid for saying that I'll sell it at a higher price. So I can use that payment to lower my break even on the stock. I can use it for whatever I'd like. Once I sell it, I get that income, and that income is mine. I can go out to lunch with it. I can do whatever. But most covered call traders like to lower their cost basis on that underlying stock. So instead of having a break even up here on the profit and loss graph, we actually move it down a little bit, and our break even is a little bit lower on the graph, saying that I kind of like to say it gives us a small pillow to land on, right, as far as break even is concerned, because it gives you a little bit of protection, but not a lot. And then you have substantial downside. So once again, you own the stock, and if you look at a covered call, the risk isn't from the option. The option is an opportunity risk. From here on up, past the strike price, we are giving up the opportunity of the movement in the underlying stock. But we still own the stock, so we still have all the downside of owning the stock, just like if we bought the stock outright. So keep that in mind, that the option contract is not adding risk to this position. It is, well, I guess there is a risk. The risk that it would add is an opportunity risk on the upside. You're allowing people to call stock away from you if it gets to a certain price. But a lot of people will do this with a limit order anyways. If I say if it gets to that price, I'm happy to sell my stock at that higher price. And so you can also think of a covered call as an alternative to putting a limit order in at a higher price to pay for it. Now, beautiful thing about this, though, is you get paid for just saying that I'll sell a stock at a higher price. And that's the difference between a covered call and a limit order. So let's walk through an example here. We own 100 shares of KRE. This is a regional bank ETF. It's trading at $40 a share. Our price target is $60. So selling a stock with a limit order would be that we're going to sell KRE at $60. Our risk here is $40 per share. If we bought 100 shares in this instance, we'd be risking $4,000. And if we say if the stock gets up to the 60 level, our reward would be $20 per share or $2,000. Now, this is an example where we're just using a limit order. We're not getting paid for saying that we'll sell our stock at a higher price. And once again, another version of the profit and loss graph. We buy the stock, it's trading here at $40. That's where our break-even point is on the x-axis here on our profit and loss graph. Here's our profit and loss graphs over here. Substantial downside because we own the stock, unlimited upside, all the way up till we get to our $60 level, and then we'd be selling the stock at that price. Now, if we do a covered call, we're going to be selling 160 strike call. We're going to receive $1. So now we lower our break even. Our break even goes down to $39 per share, which goes from the $40. We just get that small pillow to land on in case we're dropping precipitously to the downside. And our break even now becomes $39. But our reward then is an extra $100 at $21 per share, as opposed to $20 if we sell at 60. And it goes, and basically we're saying from the $40 level, which is where the stock is at, highlighting that up here, all the way up to the strike price of $60, we have that potential upside on this trade. And we're going to receive $1 or $100 per our 100 shares for saying that you can call my stock away at $60 a share. All right. Now, if we look to do this trade now, and we're considering the stock now has moved, we put the stock at 52.87. Now this is from the Options Play platform, and our optimal expiration. So in general, when we're looking at covered calls, we are saying that, okay, we bought the stock has moved up. We now see the stock is trading at $52.78 a share. Normally, if we're looking at option premium, we'd like to go out about 45 days. That's our optimal expiration. Now, in a 45-day period, on basically a 360-day year divided by 45 days, we have 8 different periods that we have a potential to sell a call option. So in this instance, one of the things that we look for is we pay attention to delta. Delta is, a lot of people think of it more so when they're buying option contracts. Tries to tell you how your option will react to a movement in the underlying stock. But in covered call writing, we like to think of the non-textbook definition of delta. And the non-textbook definition of delta is the probability of the option contract finishing in the money on expiration. Now, I don't want this to scare you, because we're just going to use this to try to pick some of the strikes that we're looking to sell. But in this instance, if you're saying it's the probability that your option contract will finish 1 cent in the money on expiration, that means if we look at, we got our stock at 52.78, we bought it at 40, we got a good solid move to the upside. If we sell the 10 delta call, that means there's about a 10% chance that our underlying stock will get called away at 60. Now, where does this come from? Well, like I said, I don't want to get too big in the minutia, but it's looking at what people are willing to pay in the options marketplace, how volatile the underlying stock, all of this is put into this number, and we're just using it as a reflection of the probability at expiration of the stock being called away. So in this instance, we got to, and you can put a period in front of this if you'd like. Sometimes you look in the option chains and it will say 0.10. This represents 100 shares. So you take 0.10, multiply it by 100, and you come up with 10. And that's a 10% chance of this underlying finishing at least 1 cent in the money. But more importantly, if you have a lower delta, you will receive less of a premium. You'll have more upside appreciation on the underlying stock, and a higher probability that the underlying will expire worthless. Now, if you do this on our 60 delta call, that was trading for $1. $1 based off of a $52 underlying stock, that is going to be about one second. I screwed that up here. So $1 divided by 52 equals 1.9%, right? That's the yield that you're looking to bring in above and beyond any dividends that the underlying stock pays. I want to highlight that KRE actually does pay a very decent dividend over time. You still get that dividend because you own the stock, right? And so above and beyond that, we're looking about 1.9%. Now, there's 8 periods within a 360-day year, if we round off to 360 days. And so if you take that and you multiply that by 8, you're going to come up with about a 15% yield if you can sell one option contract every 45 days and you go out for a complete year. Now, you still get upside potential. So by doing the 60 strike call for $1 45 days out, well, you're bringing in consistent income above and beyond the dividends, and you're also giving yourself a decent amount of upside participation before we get to that strike price and we could potentially have the stock called away. So now let's go down and look at the 20 delta, right? The 20% chance of the underlying stock actually reaching that strike price. Well, we're going to get paid more for that, right? Because we're willing to give up the stock at 2 points lower than the 60 strikes. So you're going to be selling the stock not quite as high as far as the valuation is concerned. But that 20 delta collects $125 on, and if you take that and you divide that by the stock price and you multiply it by 8, you're going to come up with a 20% yield per year above and beyond any dividends. If you can have 8 periods where the stock doesn't get called away at that strike price. And then the other one is to look at the real close to the money option contract where the underlying is trading. Stock's at 52.78. You're going to sell the 56 strike call. Now, notice each one of these deltas were going up by around 25 cents. And this is, appropriate for the timing as far as options are concerned. This is a realistic expectation using real data from the marketplace. A 30 delta would yield about a 26% yield over that, once again, 360-day year, 8 periods within that year of 45 days. So these are just things to keep in mind if you're trying to generate income. And like I said, even in retirement accounts, this is a very interesting strategy. You buy an underlying stock that pays a decent dividend. You try to sell some income to bring in dividends above and beyond that. And all you're saying is that you're going to sell your stock at a higher price at a later date, as opposed to just selling the underlying stock outright using limit orders, if you're thinking about trading that. Okay, now our goal here though is that we don't want to be called away on the positions, and we're going to talk a little bit about what to do if that is, and have general rules in place if we are doing this covered call strategy. All right, so our biggest friend of the covered call trader is Theta. We've already introduced Delta, which is a Greek that tracks option prices and option price movement, but we're using it as a probability. We're going to now look at Theta, and Theta is the change in time value of an option contract. So each day that goes away is you're ringing the cash register, if you will, and Theta is telling you how much you're putting in that cash register. Okay, so theta decay is usually based off of 1 day, and you're gonna, if you have a large theta, and here's the biggest thing about an option contract. Let me step back 1 second. Is that time is money when it comes to options, and if you want to get more time, you're going to have to pay for that. But as every day that goes by, and let's say the stock doesn't move and stays where it's at, that value that you're paying for that contract is going to erode. So we're selling the contract, so theta is going to be our friend. So here's the concept. If time decay, the extrinsic value or time value of an option contract decays faster closer to the expiration date, we have a higher theta. So as expiration approaches, time value erodes quicker than it does on a longer term option contract. So this is part of the reason why we come up with the 45-day period. You're getting slower time decay to start with, and then as expiration approaches, you're going to get larger time decay. Um, you you obviously, if you go out further in time, you get more money. If you go out shorter in time, you get less money. So we're trying to find the optimal time period where we get decent theta, decent time decay, and we get decent premium. And so this is the Greek that helps us make that decision. All right, so covered call outcomes and management. Now, in this instance, the stock hits 52. We bought the stock at 40, right? We don't mind selling it if it gets up to 60 is kind of the concept, but we're kind of hoping that we don't. We're going to sell the 60 strike call at $1. So here's the chart from Options Play showing where the stock is at and showing where our target is at. And well, in general, this is close to where the recent high was at, but that's not usually the outlook that we're just trying to bring in some income, and we're saying we don't mind on a percentage basis getting an 8-point movement to the upside. We'd be okay with that. Okay, if the ETF is called away, we profit $2,100, the $1 that we receive from the covered call, and also the movement up on the underlying stock from 40 all the way up to 60 would be 2,100 calls. But we miss out on any further opportunity. We can't get any gains. So I always kind of jokingly say this: if you sell a covered call and you're willing to give up your stock, do yourself a favor, and when it gets beyond 60, stop getting quotes on it. You said you want to sell it at 60, and a lot of people will look at it and say, oh my gosh, it's at 65. Why did I sell this call? Why did I do this? Well, in this instance, you said you'd want 60. You have to come up, you got to make a plan with yourself saying that you're willing to take this type of profit if the stock reaches that price. Okay, now KRE, if it's below 60, well, in our income generating strategy, that's a good thing, right? Because we're trying to generate income on stocks that we own above and beyond dividends. And I know I keep saying that, but that's the concept. So in this instance, if the stock is below 60, we own KRE at $39. That's a 1.64% yield over that 45 days. So if it just expires worthless, we do that. And we have potential income to sell another call for further income. Now, ultimately, you own the stock, so don't forget the fact that the stock price can move. But as long as we stay below 60, that dollar that we receive for saying we'd sell it at 60, that's ours. I always think of it as if I owned a car and I sold it to somebody, I get that cash right away. I can do whatever I want with that cash, right? It's not like they're going to drive the car around and come back and say, I don't want the car anymore, right? Give me my cash back. No, I sold it to you. It's done. It's money in my account. So in that instance, that's the same way that we're looking at an option contract, that usually if you sell an option contract, you get that cash right away and you can keep that cash. That's yours to adjust your cost basis. And as I mentioned earlier, go out to lunch if you'd like in that scenario. All right. You can do whatever you want with that cash. All right. So now, if we sell, we have no additional margin requirement. So I do want to highlight that because you're not putting any more risk in. The risk is coming from the stock. So we just sell that call, we get that cash, and looking at a 1.64% yield over a 45-day period. Now, if I look at the covered call scanner, our covered call scanner will help you try to decide what type of yield and what type of maybe even underlying that you want to trade. So let me run to the Options Play scanner right now, and I'll highlight this scan that we're doing here in Options Play. And I pulled up, this is real data today that we're using inside the marketplace. So right now, hitting the covered call strategy, you go over and you click on ideas, you click on covered call, and I just decided to sort by company name, but you can sort by yield, you could do a symbol if you would like. premium, you can actually look at implied volatility ranking. And I'm going to give you a little bit of an understanding what the IV ranking is. It's one of my favorite indicators inside the Options Play platform. And you can also look for earnings dates. So we'll highlight today is a big day for earnings as far as the marketplace is concerned. Usually everybody's celebrating NVIDIA's earnings, and it's going to be an interesting one today, but they're going to be announcing after the close. And so I'd want to know that. If I'm doing covered call trading, that is a known event that can really move the underlying stock. And I want to be aware of that scenario. But the stocks that we're looking at now have already announced earnings. And I'm going to highlight two. Well, actually, we can even look at Google here too. Well, Google or Google. These are some fairly big stocks, and this is why I went by company name. Alibaba, Baba is the symbol. They just announced earnings recently. Stock is making a solid move to the upside. 50 days to expiration. So we're looking at the expiration dates, and we want to do something right around 45 days. But in the real marketplace, there's not always a 45-day option contract, right? So it's highlighting the closest date to that expiration. So DTE stands for days to expiration. And we'll start by let's look at the advanced micro devices here. The strike is the 125 level that we're recommending to do this trade. We're looking at a stock being up 160 on the day today. Click on that trade. And if we look at selling the call against that position, it tells us the cost basis. It tells us our max reward if the underlying stock gets called away, our annualized return. So on an annualized basis, we're looking at 10%. The dividend yield on this trade for this period, 50 days, is 1.8%. And it shows us where our break even is and obviously highlights our days to expiration. Now, if we click this and we look at the trade, it's highlighting down here. This matches your income strategy, right? And if we click on that option contract, it will give us the max reward, everything that we're talking about if we want to switch up our strike prices for this underlying stock. Now, this is 29 to 39 days to expiration, which I want to highlight here. 40 to 70 days is going to put us in this expiration, and the recommendation going all the way out to 70 to 180 days would be this expiration. So let's click on this one and let's look at the 120 strike call. So we're giving, right now the underlying stock is at 105. We're saying we're willing to give away the stock at 120. The annualized rate of return would be about 14%, above and beyond any dividends the underlying stock might pay. And that is 1.88% for every 45-day period. Our break even is going to be reduced by the amount of the call that is brought in. In this instance, selling our covered call in AMD would generate 194 days of income. Static return is 14%. You keep 195 day income per contract if AMD closes below 120 by that April event. So if I want to trade this, if this scenario works for me, I click on this and it shows me the call option is $1.94. The underlying stock is at 105.55 when we clicked on this button. Shows you where the midpoint is if we bought the stock and sold the call option. And we have the option to just remove the stock if you just want to sell the call option. And this is where you'd actually select this and send it actually to your portfolio if you would like. So just to review covered calls, now if I'm looking at this list and I want to try to decide stocks that I might want to trade, I want to try to look for ones that are in the green that are highlighting a bullish outlook on the underlying stock. Now, a lot of people just own stock. They've owned stock for a long time. This will also help you try to pick that out. If I go in and I click on this box and I say I own 100 shares of AMD. I click yes. That is going to adjust my trade in this instance, and it's just going to show you the sell to open because I already own that 100 shares of stock. And then I can connect to my broker and I can send it to the trading floor via that way. All right. So a lot of times with covered calls, I usually own the stock before I sell the call against it. And part of the reason why is that most of the time, if you buy a stock, you think it's going to go up. You're not quite ready to sell it. It's okay to buy it and sell it right away, but a lot of people will wait a little bit. And if they do get the bullish upside, they'll sell the call against it. This strategy is saying we're always going to be selling a call. We're always going to trade that position. Another way to look at it is, so here's Alibaba on a recommendation. We got a bullish outlook on the underlying stock. Short-term bullish, longer-term bullish in this instance. Relative strength is 10 out of 10, which is the best ranking that we can have. And I wanted to bring up Baba more so that we have an IV ranking, and the IV ranking is saying that you are getting a decent amount of premium for selling this option contract. 50 is the average. That'll be right around the middle. Below 50 is a low implied volatility, and as far as premium is concerned, and above 50 is high implied volatility. So in Alibaba here, part of the reason why it's showing up is we're getting a decent amount of premium in our option contract, and the IV ranking is highlighting that. So this is something that you can use. Now, I want to be aware, Alibaba, obviously there's a lot of news, and this has created some of this volatility in the underlying stock. So you always want to be aware when you see a high IV ranking, like you would, well, let's put in NVIDIA. Let's take a quick peek at that. Let's take advantage of the fact that they're announcing earnings today. And that earnings event is going to be a big deal, right? So we're above the 50% level. 67 actually isn't bad around earnings. But if I'm looking to do a call on earnings, I got to be aware that the stock can get called away from me. But what in the options grid, what range of days do I want to sell? Do I want to sell the 20 to 39 days, the 40 to 70 days to stick with our monthly range of 45 days? We'd be looking at this expiration, the April 15th expiration. And if we click yes, we own stock, and we click trade, it's showing that this is bringing in $6 worth of premium to sell the 126 strike call. Oh, this is the put. All right, sorry about that. This is the call, 155 strike call. This is where we want to be. And I'm sorry, I had to put option in there. 155 strike call, which is above and beyond, which is about, we're looking just under 20 points, or just over 20 points of upside, bringing in $3.63. Now, another thing that I want to highlight here is that if I click modify trade, and I want to look at the strike prices, and I want to try to stick with my 10% delta. If I click this box, and I'm sorry, click this strike box, I can see where that delta is for that option contract. Now, if I want to go a little bit higher out and lower my risk, here's my delta here. I can actually go all the way based off of the earnings to the 175 strike and still bring in a premium of $1.15 on this. And they're saying that there's a 10% chance that the underlying stock would reach that 175 strike level and have that underlying stock called away. So here's one way to modify, is to either go back to the grid and use that, or actually hit the modify button here and look at the column to the right of the strike, and that will give you the delta for that position. All right, now if you have any questions, feel free to answer them. I'm going to work through a couple more scenarios. I'm going to look at Google here. Google has recently announced earnings. So we expect the IV ranking to be, well, it's not bad. It's right around the 50 level, saying that you're getting a decent amount of premium as far as volatility is concerned. We are in Google. If we want to look at the number of or the basically 20 delta option contract 45 days out, we'd be clicking on this. This would be the optimal strike based off of that. If we want to look at the 10 delta call, we're looking at the 195 strike here. If we want to go down to the 30 delta call, we're looking at the 185 strike here. So if I want to trade this, let's go to the 195 and we click trade. We can bring in $1.32 of premium. Once again, saying that we own 100 shares of stock here. This is where our midpoint would be if we bought the stock outright. This is where we are looking at if we just sold that call option. And all of this math that goes along with this is based off of where the underlying stock is at right now. We have 100 shares at a cost basis of $173.92. All right. How to protect stocks falling down. Okay, so we have a question in the Q&A box, and I do appreciate that if you do have any questions, please do put them in the Q&A box. If I was worried about a stock, and NVIDIA is a great scenario here, right? And I'm going into earnings, what is a way that I can protect my position? And since this is a covered call scenario, the trade that you would be looking to do on NVIDIA, and I'm just going to click trade here, would be a bearish trade. And if I did a bearish trade, what I'd be looking to do is to buy a put on NVIDIA as protection for the underlying stock. So I'm going to modify this because it is a protective put that we're looking at doing. And say the stock is at 130. We're going to go out, this is 50 days going out in time. If we bought the 130 strike put, that's a real expensive put. That's trading for $9.35, right? So in order to protect, here's what I would do to recommend this in NVIDIA. I'm not worried about NVIDIA going all the way from 132 all the way down to zero, right? I don't think the company is going bankrupt. That's my outlook for the underlying stock. So what could I do to offset the cost of this put? And the strategy that is, you have to be approved to be able to do this strategy though, is to actually reinsure your put option, right? We're buying this put for $9.35. Let's sell off some of the risk below the 130 strike. So maybe we think NVIDIA could move 12 points after earnings. Or maybe more, but let's say 12 points because stock's at 132. So let's sell the 120 strike. We bring in $5.40. So in this instance, we greatly reduce the cost of our put, and we have our risk from 130 down to 120. If it goes below 120, it doesn't protect us anymore. But this is actually a bull put spread as opposed to buying the put outright around the earnings. Now, if I'm doing earnings, and I'll click trade on that, and now the cost of our insurance policy for every 100 shares of stock that we'd own would be $387 in this instance. All right. Now, if I'm doing this because of an earnings event, what I would look to do in this scenario is go a little bit closer, right? I don't need to pay for all this premium. We're talking about going 50 days out by the April 17th expiration, maybe March 9th. Let's give it 9 days and just get us through the earnings event. And if I do that, now we reduce the cost. The cost of the 130 put, $2 below, is $6. And then the premium down to 120 is 256. And now we modify that trade. And then in this instance, we're paying $3.38. We're lowering our cost of our trade, and it's getting us through this short-term period around the earnings event. And if you want to just make it real short term, you could do the February, which would get you 2 days. And now the put goes down to 490. The 120 put goes to 120. Click bearish. Now we're down to $3.15, but it's only protecting us for the next 2 days on this trade. So interesting scenario. If you'd like to do this trade to protect yourself on the underlying stock. All right, any other questions that you want to try to address here? If you do have them, please do put them in the Q&A box, and we'll try to address that position overall. All right, and if not, let's go back to the PowerPoint presentation. This is my name. I'm Brian Overby. You can follow me on x.com. My handle is @BrianOverby. The options play site is optionsplay.com, and my book is optionsplaybook.com. If you have any questions, feel free to answer them. And right now, I'm not seeing any questions in the Q&A box. And so with that said, we're going to come back and we're going to look at the next edition of income using options to generate income inside your account, which is going to be a cash secured put sale to say, I will buy the stock at a lower price at a later date, bringing in income above and beyond. And then our plan would be to tie all of that strategy together and do the real strategy. So thanks for stopping in, and we'll see you the next time for the next event that is going to be cash secured put selling. Thanks, everyone.